risk. That's why I think real estate makes a lot of sense when you have all the rewards from real estate. You have the appreciation, you have the cash flow, you have the tax benefits, you have the ability to outsource property management teams. You can go the passive route where you have a sponsor managing the entire investment for you and have kind of your own, almost your own financial manager, right? Like there's so many benefits and the risks, there are some pretty large risks to real estate, but if you understand the fundamentals of the market cycles, how properties are valued, and really kind of the benefits that real estate offers, I think it's almost a no-brainer, especially if you're kind of planning for retirement or you're on your way to retirement. For me, at least, it seems like a lot more of a viable option than putting your money in the stock market, having the volatility there, and not getting kind of the tax efficiencies that you get with the real estate. Welcome, everybody, to a new episode where we're going to explore the evolving landscape of retirement planning. Today, we're joined by Ravi Gupta, COO and co-founder of Viking Capital. Welcome, Ravi.
Thanks, Nathan.
Awesome. We're going to dive in to discuss the growing trend of physicians turning to real estate investment as a plan for retirement. From understanding their motivations to navigating real estate strategies, we'll uncover key insights to help you redefine your retirement journey. So let's dive into it. Ravi, what are kind of the primary motivations driving physicians to really kind of explore real estate, investments? And you can even draw from your own personal experience.
Absolutely. There are several reasons. The first reason is that people are looking for alternative investment strategies. Like as a physician, especially an employed physician, you're used to the standard retirement accounts, mutual funds, securities, that type of thing. People are looking to diversify. So, that's extremely important. Real estate is also a big interest for people in general, especially high net worth individuals looking for tax efficient strategies and looking to potentially offset some of their income from real estate. The great thing about real estate is if you're investing correctly, there's good cash flow. So not only are your dollars appreciating, but you're obtaining that cash flow as well. And then some people think about real estate as a way to completely retire from medicine, whether it may be in a short period of time where they're more aggressive, or in a long period of time where they slowly put a few dollars here and there and dollar cost average until when they're ready to retire, they're generating enough passive cash flow so that they can live without needing to work and not really necessarily relying on their IRA type investments.
Yeah. Well, and that's kind of the traditional way that people think about retirement is, hey, I need this certain amount saved up in the bank, right? And that's kind of one of the great things about why a lot of people are pivoting to real estate and have, pivoted to real estate in the past is because it offers you that appreciation that normal, retirement accounts do, but it also offers you the cash flow throughout the entire retirement planning journey and offers you the tax benefits typically during that whole period as well, not just kind of waiting to retirement. And that's, I feel like a lot of physicians typically step out of their line of medicine when they get the cash flow benefits rather than purely banking on appreciation or a certain kind of dollar figure in their retirement accounts. It's more so the cash flow they get from these investments to help kind of supplement their W-2 income. What's kind of your personal real estate journey? How'd you get into it? What was kind of the motivation for getting into it? What kind of challenges did you experience along the way?
If you've been listening to this podcast, then I've spoke about my journey previously, but if you're new to it, well, we welcome you. And I'll just briefly talk about what happened to me when I started this journey. So when I began working as an attending physician in a local hospital system, I was thinking about investing in real estate as a way to generate passive cash flow and decrease my FTE. Ideally, I was looking to get down to maybe 50% FTE. My wife at the time was also looking at decreasing her FTE as well. And we thought real estate was a great way to do it. We invested in the nadir of that previous market cycle back in 2009. It was a great time to invest. We didn't really know anything about market cycles. It was just the timing that worked for us. And we were lucky to be investing at that time. But we bought several multifamily assets, small multifamily, like 2-3 unit assets in Washington, D.C. We bought 4 of those and we're able to cash flow enough so that we both were able to realize our 50% FTE. And it was a great way to, as we mentioned earlier, not only invest in something and have that cash flow appreciate in terms of the equity in the building itself, but then also generate cash flow. What we discovered over time was there was a lower return on equity. And that's an interesting figure to keep in mind. The return on equity. So as your building appreciates in value, there's equity that's generated and the cash flow is the return on that equity. That was decreasing as the equity in the complex was increasing. So I wanted to sell and reinvest. And that's how you redeploy that equity. And then you 1031 exchange that into a bigger asset and then a bigger asset. But my wife at the time, she did not want to do that. And as you men know out there, happy wife, happy life. So I was like, I am not going to argue with this. And then we kept those. Now, did we make the right move? Because after over time, we went through economic cycles, and if that cash was redeployed into something else, maybe it would have dropped. Maybe we did. Maybe we made the right decision by not reinvesting that equity. But I think if we did it, rapid succession, we potentially could have had even a greater number of assets. But that takes a lot of time and energy. And that was like something that I was willing to do at the time. Now I am at the point where I don't want to manage any more properties. I don't want to be the one on the ground. And that's where you look at passive types of investments. And I did that too. I invested passively in a lot of interesting complexes, and I did pretty well that way. And I made some mistakes as well. But again, it's about averaging, right? Dollar cost averaging, just like you're investing in like any security or a mutual fund. You invest a little bit at a time and little chunks, and then overall you expect you will get some decent returns.
And I feel like that's the natural kind of progression of most physicians, right? They kind of start off either doing passive investments, trying out different sponsors, different asset classes. They might do a little bit of short-term rentals or kind of smaller multifamily, some quadplexes, and then they can eventually make the decision, hey, do I want to go kind of more active full-time and really kind of pick up larger communities like 50, 100 units? Or do I want to kind of stick just to the passive side of things and really kind of grow my passive portfolio? What is it about physicians specifically what kind of challenges or I guess opportunities would they encounter that would be different than other high income earners?
Well, I think physicians in general are very risk intolerant. There's also time constraints. And then as a training as a physician, you have no idea how to invest your money. That's not part of the training at all. And many of us just go through the process of training and really focus on our specialty and put all of our time and energy into it. And then when we are working, we're generating this income and we don't really know what to do with it. Those factors play a role in how we think about things. And because we are risk averse, we don't want to do something that we know nothing about or we haven't put in a ton of time, energy, and focus on to invest in. So I think that's maybe how physicians would differ from other individuals. I mean, other individuals have the same characteristics, but that's where real estate comes in because again, it's a way to diversify. And there's a good quote where real estate has the best asymmetric risk reward ratios out of any investment, and more millionaires are made in real estate than any other investment. So if you're not thinking about using real estate as your primary investment vehicle, then it's certainly something that you should consider in your portfolio. And interestingly, Nathan, I was just talking to a friend yesterday, and she mentioned that there was an area outside this college town where she went to college, where there was a 12-unit building that was relatively new, like 2015 vintage, that was being sold for 1.2 million, where you could get really high rents and the cash flow was phenomenal. So in the area where I live outside of DC, you can only buy a home for 1.2 million. I can imagine buying, like a 9-10 unit apartment complex for that much, but that's what they're going for. So, it's like you can look, there's opportunities out there where you can find this type of cash flow. It just requires knowing what you're looking for, having that expertise, or maybe tapping into resources like, us at Viking Capital or anyone else that has done it before and finding out where those properties are.
Yeah. And I love how you touch on that asymmetric risk return profile, right? Because that's ultimately what you're always looking for in any investment is you have more reward than the risk, right? A lot of investments that seem really risky obviously offer pretty substantial reward, or at least they should. But a lot of physicians don't have that same risk return profile to really kind of take on those bigger risks. That's why I think real estate makes a lot of sense when you have all the rewards from real estate. You have the appreciation, you have the cash flow, you have the tax benefits, you have the ability to outsource property management teams. You can go the passive route where you have a sponsor managing the entire investment for you and have kind of almost your own financial manager, right? Like there's so many benefits, and there are some pretty large risks to real estate, but if you understand the fundamentals of the market cycles, how properties are valued, and really kind of the benefits that real estate offers, I think it's almost a no-brainer, especially if you're kind of planning for retirement or you're on your way to retirement. For me, at least, it seems like a lot more of a viable option than putting your money in the stock market, having the volatility there, and not getting kind of the tax efficiencies that you get with the real estate.
Yeah, I want to give people a couple takeaway points out of this podcast. So if you're listening to this, certainly, I mean, you're interested in real estate, you're listening to the podcast, but the one takeaway I would say is if you're looking to move, consider moving into a multi-unit property where you're living in one unit, renting the others. If you can rent 2 others, that's huge because that potentially would pay for your property, so your unit. So you'd basically live for free. You'd be able to get that appreciation. That's the first thing I would recommend. The second thing is don't invest in something just to invest in real estate. Like if you're investing in a new home and when you rent rent it, you're breaking even. You're like, hey, look, if I hold this for 30 years, I have paid for the home and I'll have it as a retirement vehicle there. That's a very poor investment. That's like very low return on your cash. It's not worth it. I know a lot of people look at those types of investments because they ask me about them. So that's number two. Don't invest in anything where you're not cash flow positive. You're not making a substantial amount of cash. And ideally, you want to make around like 7-8% cash on cash return. That's what you're looking for. The third is that if there's any project you're looking to invest in, whether it be like a home or a townhome or whatever it is, hit us up and ask our investment relations team for advice, whether you should do that. We're not here to just steer you directly in all of our projects. If you invested with us, great. If not, if we can help you in any way and make a decision, we're happy to do that too. Because we've all been there, we've experienced this, and we're happy to be the sounding board for you.
Yeah, I love that, Ravi. Can you kind of take a 30,000 foot view and kind of see, or at least explain what the differences are between, buying like a quadplex, moving in, renting it out, what the difference between that is, kind of the active strategy, the passive strategy with kind of syndications, and then how REITs and kind of larger institutional investing works?
Yeah. So buying a multi-unit in one unit is great in a lot of ways. One, you're getting that passive cash flow. Number two, if you're managing that property, you're on site all the time. Now, the downside of that is, and I'll give you an example because I did that. I was living in one unit, rented the other two. Get calls at like 3 a.m. And I remember this call specifically. This girl was like, we have a massive leak. And it was 3 a.m. And she's like, the toilet is just leaking all over the floor. And I was like, oh, great. So I wake up, go down to that unit, and I see this guy passed out in the bathtub, obviously just completely inebriated. And the cover of the tank was like split and there's just water everywhere. And this girl was totally drunk. And I was like, this sucks. Like, I don't want to be the person being called about this. And I was like, you clearly do not even understand why this is leaking to you. She was so out of it. That's the kind of stuff you don't want to happen to you. So that's the downside of doing that type of thing, right? You're on call for all these issues that may just be very annoying. So that type of project. Now, there's potential to make a lot of money off that. And, we did that. And I would recommend that to some people that have the tolerance for it. But again, you got to be a property manager and doing that stuff on site. So the second option you have is passive investing. Like if you invest with us or other syndicators where we do all that work for you, you just put your money in, we cut you a check every month, basically at your share of the cash flow. We manage it and do all the stuff. So you don't have to, you get a K1. So that K1 will help you offset your passive gains. So a lot of people like that. The downside of that is it may potentially not be as lucrative as doing it on your own because you're, in essence, hiring us to do it. But sometimes it's more lucrative if you get into the right deal with low cost basis and we're able to turn it around, like transform it, do our value add on that property and sell it at a much greater cost basis. Sometimes it's even more lucrative than what we could do on your own. It just depends. But in general, it's kind of another way to look at it. You're paying someone else to do it for you. I like that way personally now because I'd rather not deal with all the hassle. And if I trust the sponsor, I know the sponsor, I know their track record, I'd rather them do it for me. So I invest a lot with Viking. So then that is the third is the REIT option, which is good because you have more liquidity, right? You can invest and then take your money out. The problem with a REIT, and I see this on the ground because we sometimes very often compete with institutional players when we are looking to purchase properties. And many of these institutions have a mandate to buy a certain amount of assets. And they have to place that capital because if they don't place that capital, it's just sitting there. So they will sometimes buy at very high prices to fulfill their needs. And I've seen that happen. And when things go down, things go south, that REIT could lose money quickly. And it's like a stock that's dropping rapidly. And you're going to lose a lot of liquidity. And you might be thinking like when you invest in stock, you're like, oh, wow, this went down. This sucks. I'm pulling out. Well, I mean, it went down because of the poor choices that sponsor made as a REIT to purchase those apartment complexes. So you just have to be wary of that when you're investing in a REIT. Like look at the track record again, ask them how they're investing in their assets, understand their investment criteria. So that's how the differences are. Just stepping back to a syndication, we do one-off property. So you know exactly what you're getting into when you invest into it. That's how that differs from a REIT where you're investing in a pool and they're constantly investing in various assets.
Yep. Yeah, it makes a lot of sense. And I appreciate you kind of distinguishing all that. Can you talk a little about the different kind of retirement vehicles that people can and can't use? So when we traditionally think about, retirement vehicles, a lot of people say, see my money in a 401k, kind of set it, forget it. I won't look at it till I'm, 60 plus, and then I'll kind of pull my money out. But there are a few different retirement vehicles that actually work really well for real estate for a variety of purposes that some people might not even know that they have, options to utilize those funds in those accounts. So can you talk about kind of the different retirement vehicles and how that kind of works into working real estate into your retirement journey?
Yeah. So what you're talking about, Nathan, is a self-directed IRA or a solo 401k. There are two different options where you can actually invest into real estate. Many people don't know that you can invest through your IRA into real estate. And the fact of the matter is you just have to look for the right custodian to help you. We use Advanta IRA. So I would really recommend that you reach out to them. We've tried multiple different IRA custodians, and they are the most responsive. They're the most diligent out of all the ones that we've worked with. And they also will help answer your questions. So you can reach out to us and we can make a connection, warm introduction, or you can just reach out to them on your own and talk about how they can help you structure a self-directed IRA so you can actually invest through that. The great thing about investing through a self-directed IRA is that you don't have to, you're not going to use those funds potentially for a while anyway. So it's like a way to test a sponsor. You're not really reliant on the cash flow that comes out necessarily, and you can still invest into real estate and diversify that way. A solo 401k is another option for those who have their own business, and it's beyond the scope of this discussion to just talk about how to set that up, but you can talk to your CPA about setting up a 401k if you have your own business. And I believe you have to be a sole proprietor to set that up. And you can invest through that. That's actually even a better vehicle than a self-directed IRA in a lot of ways. So those are two different methodologies you could look into as far as retirement investment.
Yeah, absolutely. And kind of wrapping up the discussion, a lot of what we talked about is not just relying on appreciation or kind of setting and forgetting your retirement account, but actively using those funds to, generate cash flow, to generate tax benefits, and really kind of maximize those retirement dollars so that they're not just kind of sitting in account until the very end of your life, right? But can you talk about how a physician would go about kind of calculating or determining, hey, should I go the passive route? Should I go more the active route? How do I know what cash flow to kind of, transition out of my W-2? What's kind of the thought process there? Because I know that you've done it along with other many physicians that we've interacted with. They've done it too. And I'm just kind of curious what the kind of the strategy looks like from actually moving from a quote unquote secure W-2 and kind of taking your retirement journey into your own hands.
Yeah, that's a great question. So I think the first thing you have to do is figure out what your goals are, right? That's ultimately what's most important. Are you looking at a way to pull back clinically? Are you looking at a way to supplement your income? Are you looking at a way for this as a vehicle to retire early, maybe in 5 years? So that way you can, if you know where your goals are, then that'll really help you strategize on how to get there. So let's just say that you are looking to, supplement your income through these so you get some passive cash flow. So if you're looking at that strategy and let's just say you want to do it in a 10 years period, then you just figure out how much income you want to generate within that 10-year period. So let's say you want to generate $100,000. And if you are, let's see, you're getting 7% cash flow, let's just make up some numbers here. 7% cash flow divided by 100, doing the calculation now, is you have to invest $1.5 million approximately to get that 7%. So 10 years, you have to invest 1.5 million. And, you can say, okay, every year I'm going to invest 150,000 year over year and maybe 50,000 in 3 different assets. And over that time, I should get there. Now, remember, typically we underwrite 5-year exit. So if you're investing that 150,000 every year in 5 years, we're going to sell and then you can reinvest that. So then you're even going to hit your returns a little bit earlier. But that's, in a nutshell, the way to think about it. I was describing a 10-year time period, passive investment into a syndication, but you can think about that strategy any way you want. Like if it's your personal portfolio that you're creating or however you want to do it. But that's how I would go about thinking, in real estate investment. And this is the biggest tip I can give you, is that people don't know what their goals are often when they're investing. They're just like, I have money, I want to put it somewhere. And they don't think about what they want out of it. So that's super important, because if your goal, for example, is tax efficiency, investment strategy is very different than if your goal is to retire in 5 years, your investment strategy is very different than if your goal is to just supplement your income so you can go on like these lavish vacations every so often. You really want to think about your goals as first step, and then go from there. Now, again, if you need help in figuring out what your goals are or coming up with a plan, then reach out to us and we can help you in that way.
I love that. I love it, Ravi. I love kind of reverse engineering that thought process too, right? Because a lot of people, again, that's classic saying, right? If you aim for nothing, you'll hit it every time. Same thing for the investment world, right? Like if you don't have any goals, or if you don't know kind of the vehicles to get you to where you want, you're kind of in this limbo spot of, all right, I might as well just plug money into my retirement account and not really have it work for me. So I'm glad we kind of dove into this topic. We went over retirement vehicles, thought processes, flooding toilets, the whole shebang, so to speak. Any kind of other golden nuggets before we wrap up for today, Robbie?
I would just say take action is the big one because, many people hear this information, they process it. They're like, oh, that's cool. They're listening to a podcast on their way to work or while they're walking or what have you. And then they just forget about it. But I really think taking action is super important, especially now. I mean, we're recording this in June 2024. And I'm telling you, like the deals I'm seeing now are like the same type of potential as I've seen in 2017. Because the cost basis is so low. I mean, as the economic tide has shifted, we're seeing prices drop substantially, 20, 25%, 30% discounts on properties were at their peak. So if you're starting your journey, I would say absolutely take action, whatever action it is, just even if it's like sitting down and coming up with your goals and strategy, just do something. Take that action now and, use us to help you achieve your goals because we're happy to do that. We've done that with so many people and we're happy to help you as well.
Absolutely. Well, thanks, Robbie. We'll catch everybody in the next episode. Take care.
Absolutely. Thanks, Nathan.
If you like this podcast, please hit subscribe or a thumbs up and we'll see you next time.